Hello, Steve Lentz here. Welcome to the Prepared Mind. I'm with Discover Options and Option View. This is the reports for Friday, July 29th, getting ready for Monday, August 1st, 2016. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Welcome everyone. Hey, if you want to subscribe and get alerts to this stuff, click on the button below. Love to have you. And just introducing you to this, many of you have been watching for every week for a long time. We offer two reports for free over the weekend here: the S&P 500 Condor Butterfly Timing Report and the S&P 500 Directional Likelihood Report. These are advanced signals for advanced options traders, typically Condor and Butterfly folks, and also folks just needing a good beat on where the market is likely to go over the next few weeks. You should note this is also the this is the video version of the text blog that Frank Fahey produces every weekend. That is located at discoveroptions.com. Click on the blog link and you'll go to the blog. It's a wonderful presentation he has on volatility and great insights into the coming week ahead. If you want a free ebook before we get to the reports, just a little note about a free ebook we offer: Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Click on the link in the above right, I believe, and you should be able to obtain that. Two reports we're offering you today: the Condor and Butterfly Timing Report. You know, a lot of people put on their butters and condors at the same time every month. And what we're trying to do is really find the best market condition to put those on. It's a range trading strategy, condors or butters, and we feel that his history has shown that there are certain times that are much better to put those on than others, and we're going to show you how we come up to that conclusion and why. And so that's exactly what we're going to do with the Butterfly Report. I'm going to show you why we want to pay attention, the methodology we use, and then we're going to get into the current condition and any edge level that there might be. All right, why would you even want a Butterfly Condor Timing Report? Well, here you have the market back at the end of 2015, started to channel in a fairly tight range, about a 80-90 point range or so for the previous month. And you may have thought, boy, this is a good time to jump in. Well, using our analysis, we would have come up with the notion here and the fact that there was a negative edge for selling condors or trading butters. In fact, there was a minus 4.2% edge, meaning what? Well, it meant that basically that there was a higher than usual likelihood that the market was going to be more volatile than what was being implied at the time by the option prices. And we really want the opposite. Okay, we want the market to be less volatile than what the option prices are implying. And here we did a historical study and we showed that this particular market condition reflected a negative edge. And in this case, look what happened. Of course, one can cherry pick examples and we understand that, but nevertheless, it sometimes pays to pay attention to what the statistics are telling you. And so here we have the market condition as of now. From Friday, July 29th, 2016, we had Thursday was an inside day compared to Wednesday, and then Friday was an upswing day with a lower high and a lower low. Okay, we're above the 50-day simple moving average, and in the stochastics, the 15-3 stochastics, we're pushing 90. We're basically between 65 and 99. But we're underneath the 3-day moving average. So we're in overbought territory. It's coming off a little bit, but yeah, we had an upswing day there. So it's a very unique market condition coming off an inside day to the upside on an upswing. Okay, so that's happened roughly 34, 35 times in the past, going back to Jan of 2000. So we're going to take a look at that and make some conclusions here. Here's the question. Is this particular current condition a good one for selling option premium through range trading, butters and condors? That's the question on the table. So here's the methodology we use. We first observe how much the market actually moves from a given close. We call that actual volatility. And we go back and look at every close and see how much the market moved from that close, how volatile the market was. We then look at the market move that at the time was being predicted by the option prices, the implied volatility of the option prices. We compare the two, and we're going to label bars favorable or unfavorable. In hindsight, was a bar favorable or unfavorable for selling options premium through the use of range trading? So let's drill down a little bit. Here's the methodology. Let's take a look at a particular close, and we're going to go forward 21 days and examine how far the market moved. And we could see that it did go down to that point down there. That was about 50 points away. That reflects roughly about a 2.4% move. And that's what you could see the volatility indicator down there is the actual move was at 2.4%. Now here's the question on the table. What market move was being implied at the time by the option prices? And when you dial up the VIX and you take a look, this is the S&P 500 of course, the VIX was implying a move of 4.4%. It was implying a move greater than what actually came to pass. That bar right there would have been a good one for selling option premium through range trading, butters or condors, for example. So we would paint that bar blue and label it favorable, and we do that for all the bars going back as far as we can go, January of 2000, say, so that we encompass both bullish and bearish markets. We paint each bar blue or red, blue meaning it's favorable for selling premium, unfavorable is red, meaning that it was not favorable. The market moved in the subsequent 21 trading days more than what was being implied by the option prices. All right, so we have then the distribution here set up between blue and red bars. We're going to ask ourselves historically, what percentage of the bars going back were favorable for condors and butters? Then, once we have that number, we're going to then look at our current market condition that I just went over that's very unique, only 35 times that it's happened in the past, going to January of 2000. What percentage of those 35 bars were favorable for selling premium? And if there's a big difference, well, then we might have an edge or so. So if you went back and just looked at all the bars, all 4,100 plus bars, almost 2/3 of them are favorable for selling premium. 64.6% were favorable, blue bars. 35.4 were red bars. Okay? Now, let's take a look at our particular condition. And that's that little green triangle. We haven't had the same, an upswing coming off an inside bar in overbought territory for a long time. But of those bars that do match this condition, what percentage of those were favorable for premium? And when you look at this when you look at the 35 or so bars, 76.4% were favorable bars. 23.6 of them were unfavorable. So when you compare that to the historical baseline of 64.6, there's actually an edge here. Better than 3 out of 4 of those 35 incidences turned out to be favorable for selling premium. So historically, we have an edge. Does it mean that this is going to be that Friday's a favorable bar? No. Does it mean it's going to be? No. It just means it's more likely. There's a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. So all we can do is play the statistics. And we know going into this that it's better than a coin toss anyway. If you believe history is any barometer of the future, that at least you have a bit of an edge there based upon what the history shows us. So there is an edge. 35 is not that many. Not that great of a population to judge it from, but it is what it is. I hope that's helpful for you in deciding whether to trade butters or condors right now. Okay, now let's go to the likelihood report. We're not going to really look at implied volatility yet here. We'll angle into it a little bit. This is simply a directional likelihood report. But before we get into it, I want to make sure you know, here at Discover Options, folks, We have a wonderful mentoring program, one-on-one mentoring program to get you up to the highest level of sophistication in options trading, whether you're trading an overlay to hedge your long holdings, whether you want to take directional shots in spreads or just going long calls and long puts, or whether you want to get into this type of premium selling through condors and butters with sophisticated adjustment approaches. Okay, we offer the whole thing. We have a great little uh, offering here to get you to dip the toe in the water a little bit with some introduction, covered calls, puts and collars. Then we can ramp it up and you can get into the full boat spread trading with the adjustments and everything like that, even futures options as well. So you could go to our website, check it out, give us a call. We'd love to hear from you and fix a curriculum up that would meet your needs. The likelihood report. Okay, here's the current market condition as I showed you. It's kind of chugging along in a range here, but technically we had an upswing coming off an inside bar while we're in overbought territory with the stochastic coming down. Now, since Jan of 2000, here's the question: how often has this same condition occurred? And what happened? Did the market go up, down, or stay in the middle? Just not do much. And so we're going to examine that, and here's how we do it. We look at the historical distribution of price. I'll show you how we do that. Then we look at the price distribution after our condition has occurred in the past. If there's a big difference between the two, well, then we might have a bit of an edge. Here's how we determine distribution of price. I like to set up volatility bands from each bar's close, and I just like to see if price eventually over the next 5, 10, or 15 days, if price hit the upper band, the lower band, or failed to hit either of the band. I set these bands up one standard deviation from the close. I use a 20-day historical volatility number to determine that width, and these are log normally distributed. So here's an example of a 10-day band. Okay, I'm just as a quick way to determine distribution here. So in this case, from this close, we have a 10-day band set up, a standard deviation away. And here's the question on the table: did price go up and hit the upper, go down and hit the lower, or wobble in the middle and not hit either of them? Whatever it did, we're going to record that for that close to keep our statistics and make some conclusions. And in this case, price went up and definitely hit the upper band right there. Then we come to this close. We're going to set this out 10 days in the future. 10 days in the future. Did price go up and hit the upper, the lower, or wobble in the middle? Okay, let's go take a look. Bing, there it is. It tried to go down and hit that lower band, but it failed to, just barely there. You see that? So in this case, it hit neither of the bands. And so for that particular close, that is what we record. And so what we're doing here is from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. All right? And when you pencil that out, here's what happened from Jan of 2000 through July 29th, 2016. The S&P 500, on average, over the course of 4,162 signals, it would go up and hit the upper band almost 30% of the time, the upper 10-day band around 23%, 15-day band 23%, lower 5-day band 30%, lower 10 about 30%, lower 15 32.4%. That's the baseline distribution of price. Now, think of this. If we have a particular market setup and we go back in time, and over the 200 times that it's occurred, it hits the upper 5, 10, and 15-day band 100% of the time and never hits the lower bands. Wouldn't you conclude that that's a pretty awesome bullish signal? Right? So I think you can kind of see that's kind of where we're headed. Okay. So now we're going to look at the distribution after a specific market condition develops, like the one we just had. Now, here's the one we just had. I just showed this to you. Doesn't happen that often. I actually found a period of a few months here where it occurred 4 times. You know, where you have an inside bar and then an upswing. An inside bar and an upswing. Inside bar, upswing. Now, from each, here's how we determine the distribution. I'm going to determine the distribution in this case of those 34 or so signals, as of the close, those incidences where it exceeded the high of that band, where, in other words, where if price were to go up above Friday's high on Monday, I want to know the distribution of price if it exceeds the high from Friday. I want to know the distribution of price if it goes below the low on Friday. I think you would agree that that would kind of help us determine Monday's action a little bit and give us kind of a better clue. I wish there was more than 434 closes, though, on this. So here is the distribution as of the close, and these are 35 symbols, 35 signals. Look at this. Again, here's the benchmark historical. Of those 35, it would hit the upper band 37% of the time instead of 29. So there's a 7.7 positive edge. It's hitting the upper bands. It hit all three of the upper bands more often than historical, and it hit all three of the lower bands less often than historical. See that? So this is quite bullish. Just as of the close, this is quite bullish. Now, what if it exceeds Friday's high? Then what? Okay. Kind of a mishmash. If it exceeds the high, it's hitting the high more often, 2 out of 3 times, and it's failing to hit the lower bands. Not too much of a surprise. And then of the 8 times it went down below Friday's low, it actually would reverse course and hit the upper band still a bit more often and fail to hit the lower bands even then, quite a bit. So all in all, I think we're kind of leaning bullish as to this. I just wish there was more than 35, but again, it is what it is, and it's interesting. Now, so what I like to do also is, instead of using a 20-day vol number going into these bands, I like to use the option prices. Okay, and here's what I like to do. I use a volatility input on the upper bands that's a little bit lower than what it is on the downside bands. I'm using the VIX. I'm skew adjusting the VIX because of the vertical skew in the options, so that the upside volatility is lower than the downside volatility. Now, the VIX in general is higher than statistical volatility, so in general, these bands are farther away, and they're hit then less often. Instead of 23 and 30% and 32%, they're getting, look at this, they're getting hit roughly 15 to 20% of the time, because the bands are farther away, because the VIX is generally higher. I skewed this, though, so that the upper bands are closer to the close than the lower bands, which are farther away. Okay, just to reflect what the option traders are saying, through their pricing. Now, when we do it this way, here you could see that both the upper and the lower bands are getting hit less often. The lower bands are getting hit way, way less often. You can tell, not getting hit much at all. They're farther away, and they're getting hit even less often than the other bands that we recorded. And it's kind of that way across the board. The lower bands are really rarely getting struck. The upper bands are getting struck, but not near as much as when we did it the other way. Here, down here, if it exceeds Friday's low, it actually can go up and hit the upper band a little bit more often than historical. So all in all, a fairly bullish picture based on history. Does that give us a guarantee? Absolutely not. We only got 35 signals, and even then you had 1 in 10 actually going the other way and being bearish. So nothing's a guarantee in life, but I think, judging from history, the statistics are fairly clear. How would you take advantage of this? Well, I want to alert you to hear that the statistical volatility is very low right now. Been chugging along, not really doing much. The upside volatility from the VIX, when we skew adjusted, 10.2. Downside volatility skew adjusted is 13.5. Let's take that 13.5 number, okay, and let's plug it into option view and look at a possible hedged bull put spread. I like to do this in my Metastock program. I'm showing the VIX, then I skew adjust the VIX to show a downside and an upside. In this case, we're at 13.5. Let's plug that number into option view here. And I don't have it up here. It's the SV number way up there. That sets the one standard deviation using 13.5. We're going to sell a bull put spread a standard deviation away and use a bear put spread to hedge it, making sure that we have a net credit. And I find that 30 days out, to do a 1-lot debit spread and a 5-lot 20-point spread gives us roughly 4 to 6% yield if the market does go up. Okay, just like that. So no matter how far the market goes up, we're still going to make 5-6% or so. If the market goes down, this hedge kicks in. It lifts up our T plus lines, and so that even at expiration, you could see we'd make 17% all the way down the full standard deviation to the downside. Okay, so all in all, it's a pretty interesting looking trade because we have an 88% probability of profit. If the market does go down and cause us some headache, at least we'll be rewarded if it doesn't go down a full standard or more than a full standard deviation. We could make 3 times what we could on the upside. So then when you look at the price chart and the profile there, we can make some money on a good array of price possibilities. Okay, just an interesting idea for you. Folks, I'm Steve Lentz with Discover Options. This has been The Prepared Mind. Good luck trading this week. We'll see you next week, same time, same bad channel. Take care. Bye-bye.